Welcome everybody. Good morning. I am Jennifer Butchart, Associate Director of Plan Giving at University Hospitals Kingston Foundation. Welcome to today's webinar on the role of life insurance in your financial framework. This webinar is part of UHKF's Values-Based Financial and Estate Planning series. Before we get started, there are a few things I would like to mention. First, today's webinar is being recorded. And there will be time for questions at the end of the webinar. You can ask a question at any time during the webinar using the Q&A feature on the toolbar located at the bottom of your screen. It is now my pleasure to introduce Rick Tomalty. Rick came into the financial services business in 1985 as a freshly minted university graduate and has enjoyed playing a variety of roles both in the corporate side of the industry and as an independent financial planning practitioner. He has been a member of the ownership group of Caldwell Wealth and Estate Advisory since 2012, and together they have steadily evolved to become one of a small number of true fee-based planning and wealth management firms in Kingston. Rick and Carol, his wife of 36 years, treasure the relationships they enjoy with their two adult sons and their spouses, along with their two granddaughters and grandson who is on the way. They make Kingston their home, where Rick has been active in the community, coaching minor hockey and supporting charities that impact the local community and beyond. Welcome, Rick, and I will turn it over to you.
Thanks, Jennifer. And I want to welcome the viewers. I appreciate you joining our session this morning. And I will put a little bit of a caveat into our conversation that if you suddenly see me mute myself, please don't take any offense to that. I've been fighting a cold, and I don't want to have you hear me maybe cough or clear my throat. Our conversation today is about the role of life insurance as in your financial framework, as Jennifer described, and the purpose of it really is to put under the microscope for 40 minutes or so, put under the microscope a kind of a unique planning tool that really supports families and communities through a person's entire life, variety of life stages. So what we're going to do today is I would like to start out with just a kind of give us a baseline, because many people understand life insurance and how it works to a point. Others are maybe not as familiar with it, and so I'd like to provide us with a bit of a baseline of where it starts from, and then how it serves households and communities in different stages of life, from young family through to retiree and into estate planning. Also, life insurance is used by some as a method of supplementary wealth accumulation. So we'll talk a little bit about what that means and what role it can play. And then near and dear to our hearts is the role that life insurance can play as a really unique tool for families and individuals who have a philanthropic bent, who want to leave a legacy, a financial legacy in their community as well as with their loved ones. So we'll start walking through that together. We will be having a period of time at the end for Q&A. So if you do have questions, I believe Jennifer is monitoring the Q&A list, and we'll come back and visit those at the end of our talk. So the role of life insurance, it was mentioned that I've been in the industry for, if anybody was counting, about 41 years. And early in my career, this was an area of specialty and of mine. And I remember being trained in the early going about how to best explain life insurance to people. And if we look at this graphic and we start at the left-hand side of the screen where we have the young family, when in the event that somebody were to pass away, And this is really specific to the younger family situation. If someone were to pass away, obviously they leave an enormous emotional gap, but they also have there's two needs for money in that type of situation. First of all, there's a need for cash to take care of final expenses, unpaid bills, taxes, mortgage, for example. Those are immediate cash needs that people often are quick to identify. However, in the other part is the need for income, because often that person who has passed away is of a part of a ecosystem, financial ecosystem in the household where there's maybe two people working, and the lifestyle is built around two incomes and the presumption of an ongoing two-income household. And suddenly one of those incomes is gone. And with one of the incomes gone, um, you have a trajectory that's been kind of built on two incomes, but now the resources have significantly dried up. So the role of life insurance is really a promise. A life insurance policy is really a promise that in exchange for a set stream of premiums being paid, the insurance company is promising that at a certain point in the future, if something happened to one of the insured people, there would be an injection of capital, tax-free, into that household, into that business, whatever the case may be. And part of it is designed to supplement. We hope if it's programmed properly, it's designed to supplement and compensate for the loss of an income. So in the early going, you're really protecting your household against a cataclysmic loss. And I remember how real that came to me. It's one thing to talk about it. It's another thing to be sitting around the kitchen table and having someone in a high chair. And that one, it struck me. I still remember the visceral realization of this child depends on me being here. And all the dreams and aspirations we have for them, we want to continue on whether I'm here or not. And life insurance is a primary instrument to ensure that that can give people the agency to ensure that that happens in their household. As time goes by, we take on mortgages, we start businesses, we enter into different things, and life insurance continues to play that role of covering the risk of a financial loss, of an income loss, and due to the loss of, again, a family member or maybe a business partner, whatever the case may be. And it really can cover off things like business debts. It can provide for assurance that even if I don't see this happening myself, I can know that my children's education is fully funded, and that they are not disadvantaged by something they had no control over, and maybe none of us had any control over. And for that reason, we see about 60% of Canadian families uh, own insurance coverage of some sort. I would have always thought that that would be much, much higher just because of the world that I live in. But I can say that that's probably about right. About 60% of households, meaning 40% of households, do not have this type of protection. Sometimes that's out of choice, sometimes that's out of a lack of awareness, and sometimes that's out of medical circumstances that cause them to be not eligible to get life insurance because it is one of the few financial instruments in a person's life that you have to be healthy to get, and that's why you get it early. Then, as we continue on through our life stages, as we approach retirement and through into retirement, into the state, um, the insurance contract that may have started everything back 30, 40, 50 years ago can play a very different role. Yes, you don't need it for the same reasons as you needed it when you're in your 20s or in your 30s and young family and mortgage debt and so forth. But now it plays a role in maybe it's preserving the estate against erosion with taxes. Perhaps it's making sure that the wealth that you've built up can transfer smoothly and in whole to your heirs. And perhaps it's your way of saying this, I'm going to have assurance that my community is going to benefit and from my being here. And the different institutions and the agencies and organizations that contributed to my lifestyle and the betterment of my life, I'm able to pass that forward, something forward to allow that to continue on to future generations. So life insurance really plays a role throughout a person's lifetime. And we're going to continue to drill in that a little bit more. I want to take a moment and talk about the different design of life insurance products. There are basically two categories. There are temporary insurance coverages, and there are permanent insurance coverages. And as the names would suggest, temporary, which is really represented in the marketplace when you hear someone talk about term life insurance, is they're designed for covering a financial obligation, a financial exposure, so to speak, that has a finite window. Classic example, we don't enter into a mortgage thinking we're going to pay for this for the rest of our lives. We usually have it on a 20 or 25-year amortization, and if we stick to the plan, that obligation is going to disappear at the end of the 25-year term. So term insurance, protecting myself and my family during that 25-year window, for example, is just perfect logical conclusion that if something happens to me midstream, mid-plan, the money then comes in and it pays out, allowing the others and people in my life to be able to get rid of that debt. And so they go forward without carrying that debt that I was partially responsible for. It's kind of like our car insurance, kind of like our home insurance. If nothing bad happens, then it's at the end of the term, it's done. We don't get any money back. There's no residual value to it. But it's very affordable at the front end. If anybody says to me, if they're in their 20s or their 30s and they say, I can't afford to have the temporary coverage that I need, I would really suspect that they've been misinformed because I've never run into a situation. It's always the cost is always in direct relationship to the amount of exposure, amount of risk that a person or household is under. So affordable cost. It's set for it's locks in that cost for a period of time. But it's just insurance, pure insurance, pay the money, get the coverage, nothing more to it. You can continue on these programs at the end of 25 years, maybe your term is up. It'll automatically renew, so no asking of any health questions, but the price escalates. And it can escalate exponentially. And so this is where we will counsel with clients saying if we see a long-term need to be put in place to be covered, term insurance is at best a short-term solution that has to be addressed before you go too far down the road. But if it's a short-term finite need, then you've got it covered. On the other side, we have the permanent policies, and those, as the name would suggest, they are designed to you can never outlive them. They will be there for as long as you're alive, and they will pay out someday, 100% certainty. So and they tend to have other features. So it's a lifelong coverage. You never encounter an expiry date or a renewal date. The premiums, the cost is usually fixed right at the beginning, and that stays with you throughout the entirety of your life. And there's a reserve that's built up because in the early stages of your life, you're overpaying so that later in your life you can underpay. Well, the insurance company builds up a reserve, and many of these permanent policies basically give you access as the policy owner gives you increased access to that reserve. And the reserve is basically made up of the premiums that you've overpaid and those premiums are being invested, and you gain a portion of access to that. It works well as an exit strategy if your situation changed and you said, I need to shift gears and this product doesn't fit me anymore. You might get your money back or even more. Um, so it's suitable for long-term planning. Um, we'll talk about it more as a wealth building tool. The cost is higher than the term insurance that we talked about, the starting in cost. But once you're 10, 15, you're playing the long game, you'll look down the road and you'll say, that cost is a deal later in life because you can never replace that. There is another product called Universal Life. I won't spend a lot of time on it. It came out of the 80s and 90s. It's a product that is in vogue when interest rates are high. It goes out of popularity when interest rates are low. It has offers a lot of flexibility in how much you're paying in and so forth, and it builds a side account that you can have access to. It is fraught with risk, however, because of the way it's designed, because of the flexibility in putting how much money you put in. You may end up saying, well, I'll put in the lower end of the scale of what I need to put in, no, thinking that later I'll add to it. Problem is, as you age, the cost of insurance goes up, and too many of these, in my experience, don't survive to late in life. And so that's just a sidebar on the different products. But basically, we want to talk about permanent versus temporary insurance. We want to talk about a coverage that would be locked in for life at a set cost. It would have exit strategy available for you versus on the term side, escalating cost, no residual value to it. And so I'm hoping that this information will become more relevant as our conversation goes along this morning. And so we've touched on each of these: the insurance benefit, the cash value accumulation that's there that you may or may not have access to depending on design. Excuse me. Possibility of having some flexibility in your premiums. There are tax advantages as well. All the insurance proceeds get paid out on a tax-free basis. Okay. And some products now, it's becoming much more popular, that they will accelerate the payment of a death benefit in the event that a person is diagnosed with something that is terminal, and there's a prognosis that is going to expect a passing within 18 months or 2 years time. The insurance companies will release money from the policy, death benefit from the policy prior to death. Okay. Okay, so we're continuing to drill down on the topic of having life insurance across the different life stages. And I've talked on each of these: safeguarding income during midlife. We talked about how it can be used as an injection of capital, creates a investment pool. Investment pool can generate an income stream, and that income stream is what helps supplement a family's income when a income earner is taken out of the picture. And both permanent and term insurance can solve that issue. As we progress through, responsibilities grow, like kids getting ready for education, entering into mortgages and multiple mortgages, going into business, that type of thing. And so insurance still plays that role there. Accumulating wealth, and we will look at how that would be relevant in certain situations. And I will say that we think of preparing people, positioning people for retirement. The visual image I have in my mind is having different buckets on the table when we're talking about structuring retirement income. And people have RSPs, and people have their own pension plan, and they'll have tax-free savings accounts, and they'll have regular, say, investment accounts. And we add the bucket of the cash value of insurance because there is a way of drawing out that cash value, actually multiple ways of drawing out the cash value from the insurance policy without gutting the insurance value, um, but using it as a tax effective way of supplementing retirement income. So, and it has its place in certain contexts, not for everybody. And then retirement planning, again, a bit of an overbridge there between the wealth accumulation and the retirement planning, but it's the money that the reserve that builds inside that policy builds tax free or tax deferred is a better way to put it. And if it's paid out as an insurance benefit, it goes tax free, but there's also there's tax preferred ways of drawing that capital. Excuse me. So when we get to retirement, where does insurance fit? Because a lot of people say, well, my house will be paid for. I will have RSPs built up. I will have earned my pension entitlement. My kids are through school, and I would be the last person to argue against saying those things. Those things typically our trajectory takes us to those places where all those things are happening. However, if you've ever settled an estate, if you've had a parent that has passed away or a spouse who has passed away, um, you recognize that the early comment I made about there's two needs for cash, need for income, but also the need for immediate cash, final expenses, legal fees, maybe some unpaid tax liabilities. And my personal story is in 2022, my father passed away at the age of 91. A wonderful man, and he was a man who prepared and provided for his family. In that, they had their house paid off, they had numerous investments, their retirement was pretty, nicely funded. He'd been a business owner and like an entrepreneur, so he didn't have his own pension plan, but they had really saved money. Um, but when he passed away, he also had permanent life insurance. And we needed, the other part of the story is that he was a caregiver of my mother, who was a few years younger, but suffering from dementia. And we had to quickly get uh, care for my mom immediately into a retirement home with a memory wing. We couldn't convert the house into cash right away. We didn't want to face the tax consequences of drawing down RIFs right away, accelerating the drawdown RIFs. But we had this sudden injection of very quick, it was the first check we got from a life insurance policy that took the entire financial pressure off the situation. We had the reserves on hand to provide for my mother, who couldn't provide for herself. And if any of you have had the experience of caring for loved ones who are in retirement homes or care homes, you know that that's not an inexpensive venture. So having the liquidity, having the immediate access to cash uh, at the time when this all developed quite suddenly I'd spoken about it for years and I lived it. I lived it in those early months. Um, the also to continue the story, my mother passed away this past August, and now not estate taxes, sorry, the income taxes involved with some of the assets that they held that passed on tax, tax deferred. from my dad to my mom, suddenly it's time to pay the piper. And so the availability of cash to pay the tax bill that comes along with having X number of dollars in RIFs remaining, and so forth, those just invaluable having the access to cash. So that's my case, so to speak, for the value of having life insurance at an age when really many of the financial obligations are gone. Um, and then also I've mentioned about in the event of I have clients who look at the cash value of their life insurance as an important piece of their overall retirement ecosystem. So we know how they're going to draw down their RSPs, and we know how they're going to draw down their TFSAs, and they might downsize their house, hopefully not out of financial need, but just out of too much to take care of. But they also have potentially millions of dollars in the ability to access tax preferred money income stream that will help to supplement these other sources of income during retirement. And that's a whole different conversation. It can be a 45-minute conversation of its own. So we won't go into that today, but unless there are specific questions about it at the end. Okay. When we use life insurance for wealth accumulation, we'll drill down to this a little bit more, but uh, the cash value, you'll hear that term whenever you're talking about a whole life insurance policy or a universal life policy. They'll often talk about it as being the side account. Um, the basically the excess premiums we paid over the years are taken by the insurance company. They're invested for future use. And as time goes by, you get um, access to a contractual access to a growing share of that reserve. And so that's your money. It's growing tax deferred. You're not having to pay income tax on the amount of growth that you're seeing every year, as long as the money stays inside the policy. So often what's happening is the dividends, they call them, are being used to buy more insurance. So you may see your insurance benefit go up over time. That's a great response to inflation. Um, and you and you see the cash value, those increases in the insurance, well, they're sellable. You can sell those increases for the cash value. But as long as you keep them in there, you're not facing any tax responsibility or any tax liability for it. You can also, how do you unlock that money though? Well, there's a number of different ways. One is through what they call a policy loan, which is the most traditional way of accessing the cash value inside insurance policy. You can go and borrow against the value in the insurance policy in that reserve, not the death benefit, but the cash reserve. You can borrow against it in the same fashion as you can borrow against the equity you've built up in your home. It's a great comparison. If you have your home, whether it's mortgage free or not, the longer you've had it, the more equity you have in it, the closer you are to having it paid, fully funded. And you can enter into a negotiation with a bank to say, I've got $1 million of equity in my home. I would like to unlock that for my personal use. Um, and notwithstanding the understanding that uh, that I'm going to pay interest on that loan. I'm going to have access to it that is really unfettered. I can borrow against it. I'm not paying income tax on the money I'm taking out because it's a loan. Um, and in the insurance side, if I were to pass away, the death benefit is calculated as being what my normal death benefit would be, minus any amount that I've drawn out of the policy, plus any interest that I have not paid on that loan. So, and typically, again, when you take those loans out, typically you're drawing those loans out tax free, and you have the ability to pay it back. if you want to reestablish your insurance benefit or put the money back in for another rainy day when, 5 years down the road you want to borrow against the insurance policy for some reason. It's really effective that way. Okay, but there are other ways of accessing the insurance benefit. You can surrender part of those they call them paid up additions, the additional insurance that the dividend is paying. You can surrender those and just take the cash. You can't put it back in. There's no interest rate assigned to it. It's like um, taking and selling a part of your house. The analogy is a little bit rough on that one, but it's you're taking the money out. There's no interest charged to it because you're withdrawing it without the right to put it back in. And the policy um, adjusts. We have to adjust the expectations for the growth in the policy, considering that we've withdrawn a chunk of money. Okay, it's very, very logical. Another piece that we see in growing in popularity with substantial permanent insurance policies is those, as I mentioned, those insurance reserves, the premium reserves can become quite substantial. And I have a client who has upwards of $2 million of cash value. And the strategy that he's employing is that at some point he will use that asset. Think of it like a house that's fully paid off. He'll use that asset as security against a cash value line of credit. So as he goes into retirement, he'll be able to draw against this line of credit, not repay it if he doesn't want to, probably not. And knowing that there's plenty of insurance there, that if he's withdrawn $1 million or $1.5 million, there's still probably another $1.5 million or $2 million of life insurance that will pay out after the loan has been paid off when he passes away. So it's a pretty effective way to draw funds out. And when you're drawing them out under those circumstances, drawing that income out, you get it tax-free. Okay. And speaking of tax-free, I'm sorry, I jumped the gun. Speaking of tax-free, as I mentioned earlier, the death benefit of insurance policy is paid out tax-free. And so we're constantly advising clients when they're settling an estate, this check that you're receiving from XYZ life insurance company, it's private. Nobody knows that they've paid it out to you, and nobody needs to know. You don't have to report it on your taxes or anything like that. Okay. So as we shift now, as we go through, we're working through retirement. Now we're starting to talk about legacy. I'll paint a scenario for you. You have your house is all paid off, and it's been a terrific place to live. You have tons of memories of raising your family in your house. Over the years, you've been blessed with the financial resources to be able to buy a cottage, and everybody in the family enjoys a cottage. You love seeing the grandkids out there for using the cottage, playing at the lake, whatever the case may be. And you're faced with the question, someday I want to pass this cottage on to my children, um, but I'm not sure how to do it because I've got um, you know part of my family, two of my children and their families live close by, and they get a lot of use out of the cottage. But I've got my daughter and her husband and family are in Calgary, and they never get to use the cottage. Is it fair to my Calgary family that that they get a third of a cottage that they never use? Well, that might be a worst case scenario, but is there a better way? So, maybe I decide I'm going to put in place um, a system where the two local families can share the cottage, and my Calgary family is going to get a cash equivalent for her share. Now, where's that cat? Then that way they can use the money as they want to, and so forth, and they haven't inherited something that they would never use, but maybe are responsible for one-third of the costs. Now, where do I get that money? Well, unravel some investments, but maybe I'm doing that and I'm triggering taxes that I don't want to trigger. I don't want to, I can't leave them if I leave them my RIF balance, well, that could be cut in half because everything that comes out of an estate as a RIF payment is subject to income taxes if I took it all out the day before I passed away. So that's not very efficient use of my estate. What if I had a life insurance policy that was equal to my daughter's third of the value of her of the cottage, and I'm going to use that to she's going to get that portion as the cash equivalent to the value of her value of the cottage. I've paid pennies on the dollar to create that insurance pool. The timing's right because I really don't need to pass this ownership on until we're both, both my wife and I are gone. And it's going to arrive in her hands tax-free, so no burden to the estate whatsoever. That looks like a really good way of equalizing the inheritance of families and being able to pass wealth across from one generation to another. Um, and then so it gives you a sense of how insurance could work from a legacy side. We talked about retirement funding. A business succession, if I've got a business partnership and one of the partners passes away, um, I've got to buy out that partner's shares. How do I do that at a time when maybe I've lost an important person that's key to the business? Life insurance can play a role in paying off those shares to the surviving spouse. And then we talked earlier this morning as I was describing some of my own situation, my own experience of providing liquidity to the estate. And I won't expand on that much more. But I do want to spend the next few minutes just talking about how families are using life insurance as a philanthropic gift. And it's a it's a huge strategy that is being used. And you can see this is a US number from a few years ago, but over $1 billion a year are being gifted out of insurance policies to charities. And the way this works from a charitable standpoint is that um, we can give a charitable gift from the estate. So I've got an insurance policy, and maybe my family's the beneficiary, um, and we decide though in advance that we're going to use the money from that insurance policy or a portion of the money from that insurance policy to not only enhance the financial legacy to my children, but I want to contribute to my community. I want to contribute to the betterment to the community that made my life better through my lifetime. And so I can arrange for the estate to make a charitable donation to a charity of my choice. And the way it works, I'll give you an example. If we look at the left-hand side of the screen where it says charitable gift from the estate. So we have an estate of $1 million. 200,000 of that $1 million in my scenario is in registered money. So I'm dealing with one of those today where there's more than $200,000 in remaining RIF. The people have been very diligent in not drawing down their RIFs too much so that they want to make sure that they don't outlive their RIF money. But we've got $200,000 left over. And the shock comes when they realize that the executor realizes that $200,000 has to be taken into income in the same year as the final family member from that generation passed away. So mom and dad may pass away first. It can pass to mom, but mom passes away. She's got 200,000 left of their cumulative RIF. It's as if she took it out the day before she passed away. So the tax bill on that could be as high as $110,000. So the estate has to come up with $110,000 from somewhere to pay that tax bill. But let's suppose the rest of the story showed that there was an insurance policy there worth $250,000, And that insurance policy flows in, the proceeds of 250,000 flows in tax-free, and the family uses that. The executor has been given authority to use money like that to make a charitable contribution to a charity of the family's choice. Well, that $250,000 reduces the estate's tax burden by over $100,000. So now we've found a $250,000 insurance policy that wasn't part of the $1 million estate calculation, and it has preserved the estate. It has basically offset the tax bill with that RIF. Okay. So that's one way of making a charitable gift at estate time work for a household, for a family, from one generation to the next. Alternatively, um, this is an example of somebody who's thought ahead of it. I'll use an example of clients who've said, I want to, when I die, I want to give money. I want to see money go to this charity of my choice. Could be a summer camp, could be hospital foundation, could be the Boys and Girls Club, anything that you can think of that's a charitable has charitable status. So they can buy an insurance policy today with this goal in mind that either a foundation or a charity is going to be the owner. I'm going to transfer the ownership of this insurance policy on me over to the hospital foundation. I'm using them as an example, and this is not something they asked me to do. But if I mention them or any other charity that comes to your mind, I can give them the ownership to it. And each year, as I pay the premium on it, I get a tax. It's the premium is the charitable gift. So, for example, I go back to the example of the $250,000 life insurance policy. Somebody does this at age 45, and it's costing them just under $6,000 a year. And by the way, we've set it up. The person's 45. They want to have this all funded when they retire at 65. So it's all done. Premium obligations are all done in 20 years. So they have paid $6,000 a year for 20 years, $118,000 to be more exact. And over the years, they've received charitable contribution receipts of $5,921 a year to that charity. Okay. And so then the tax relief on those charitable gifts is as high as $47,000. And so I've put in $118,000. I've got $47,000 in tax accumulated. So I've given a gift that's worth $250,000 and it's cost me $71,000. So that's another way of how you can structure a charitable gift using life insurance. And I'm really watching my time now. Um, I wanted to kind of close off in a moment, briefly here, speaking about foundations. And I'm a big fan of foundations because what a foundation allows you to do, if I'm, um, I have philanthropy in mind, um, but you know what? I really like such and such an organization that is a charity. But what happens if they're not around when I die, when my insurance policy pays out? Well, I can I can pay the make the gift into a foundation, and uh, foundations are charitable entities of themselves, but they are commissioned that they can give the tax receipt, the charitable gift receipt, immediately upon receiving the gift, even though the gift itself is not going to be distributed until some point in the future. And what it does is it allows for um, people to bring their whole household into the decision-making process where they can, it's called donor advised giving. They can say, I want this money to go to this camp, this college, this religious institution, this local food bank, um, and but I want it to be paid out over a 10-year period after I pass away. I want it to be, And any time along the way, if any of those institutions change or cease to exist, my family or I can come in, oh, okay, we're going to take out this charity because it's no longer operating, and I'm going to put in this one. So it gives you an opportunity, it gives you the opportunity to have the charitable donation receipt at the time of giving, even though you want to have those funds distributed over a period of time and perhaps across generations. This is how endowments work, bursaries work, and so forth. And it gives parents an opportunity and grandparents an opportunity to engage the generations that follow them in the idea of philanthropic giving. Okay. And so, just in closing, whenever you're structuring something like this, you want to choose the type of life insurance, permanent or term, what best suits your control and situation. And predominantly, when we're talking about estate planning, we always narrow our focus in onto the permanent side. You want to align the beneficiary designations and the ownership, depending on what you want to accomplish with your giving. Optimize the funding. You can choose to fund some of these permanent policies in as early as 8 years. So you want to match the funding with your own personal timeline on how long you want to be committed to making these payments. And then those things will kind of dictate, the structuring will dictate whether you get the contribution or the estate gets the final entire gift as the tax credit. You don't get both. And so with that, I think I'm gonna wrap it up, given the time. This was just kind of a summary piece, but I'm going to turn it over to Jennifer for any questions that may have come up. I hope
Sure.
this has been
Thanks, Rick.
valuable.
And if anybody has any more questions, please feel free now to add them to the Q&A, and we can see if we can get to them. I do have a couple questions for you.
Sure.
The first one is around term and permanent life insurance plans. So if somebody has a term plan right now and is thinking, that might not be the best one for me, maybe I should be changing to a permanent plan. How easy is it to do that? Is there another application? Do they have to go through other medical tests requirements and all of the things that they did when they first did their term plan?
Great question. These are the things we don't have a chance to explore in detail in 45 minutes, but the answer to the question is that typically the term insurance policies that are in place today will have what they call a conversion privilege. It's a contractual right for you to upgrade your policy from being a temporary policy with an escalating cost and an expiry date at some point. You can upgrade that to the permanent side of the design, uh, as long as that company offers that type of product, and there's no medical questions asked. So, so it's an enormous benefit because we tend to get less healthy as we get older. But our financial situations change where today a family may not have been able to, or when they started with the policy, they weren't able to budget for something more permanent and more robust. But now circumstances have changed and now they're in that situation. They have you typically until age 71 to exercise that conversion option, to upgrade, no medical questions, but now you're adopting a new payment structure. I hope
Great.
that answers the question.
Yeah, I think so. Um, so sometimes people hear the idea that, oh, you may have too little or too much life insurance coverage. What types of things should people be thinking about when they're trying to determine their current life insurance policies? Do they have too little or too much?
Yeah. So typically, a financial advisor will go through should go through a discovery to identify where the financial risk lies. So easy ones are what do you owe on your house? What do you owe on your car? What do you owe on your student loan? What do you owe on your business shares what type of debt does your business carry? Those are numbers are quite easily quantifiable. And then shift to, okay, now what have from an ongoing income, can my family, if these other bills are taken care of, can my family, can my business continue on without the income that I used to be contributing? And if they can, then we know that, okay, we don't have to worry about insuring the income. We just insure the debt. Unless people are comfortable, passing that debt along. Most people are not. Most people, want to have that dealt with. And so I would just recommend you to see your financial advisor to do an assessment that because we see it regularly. People will buy a large amount of insurance when they're young, which is great. We'll use term insurance because, the dependency is sitting there in the high chair and they're going to be dependent on you for a long time on your income. People get through the other side of that, they may still be carrying $800,000 and will say, okay, is that really relevant? Is it to your current situation? Maybe, yeah, there's need for insurance. Maybe it's not that much. And so it really needs, get a financial advisor to have a look at it for you to help determine what the right amount is, given your circumstances today and what you want to accomplish.
Um, when it comes to life insurance, and some people will have life insurance through their employer, would you want them to consider maybe having a life insurance outside of their employment, just to ensure sustainability and
Yeah.
protection?
Yeah. Group insurance is a great benefit when you're working, when you're employed for somebody, by somebody. And however, it's the cheapest form of insurance, but it's also the least effective form of insurance. I'll expand on that. You do not own the contract. The employer owns the contract. So if they change carriers, you might be just told unilaterally, oh, the amount of insurance that you have now is dropped. It's no longer two times your income. It's a flat 25,000, right? Could be a big shock. So you have no control, you have no say in it. It does escalate in cost, and at some point you're going to leave it behind because when you retire, when you leave that employment for any reason, typically you're leaving all that insurance behind. You're leaving those benefits behind, your dental plan, your health plan, your disability policy through your coverage through work, and your life insurance all stay behind with the employer because you don't own it. And so you'll be given a window of time after you leave to convert the life insurance within that, whichever carrier is providing. You can convert it with no medical questions, but you can convert it into a very limited shelf of insurance options. And it can be quite costly because they have to build in the risk that you're not otherwise insurable. And one of the big benefits of being a group plan is that I can join a group plan, get the coverage even though I'm not insurable. I wouldn't otherwise qualify. So it has its role, certainly, but I'd never counsel a household to rely on it and it's certainly not as an estate tool because you're going to most likely outlive the group benefits, having group benefits by the time you pass away.
Is there an ideal age for a donor or minimum timeline for insurance policy with a charity as beneficiary to build value?
Um, Great question. Now, one thing I would say is building value. When I hear that, I'm interpreting as building kind of a cash value inside, because the insurance value, the death benefit, we'll call it, it's set at the beginning at can be set at a very high number relative to what you're putting into it. And if a person passed away the next day, literally passed away the next day, and they have paid $100 for their first monthly premium, and they passed away the next day, that insurance policy would pay out in full unless there was something untoward that was happening. It would pay out in full. So when we're thinking of charitable giving through life insurance, we think of the death benefit as the gift. And that starts out at 100% from day one. Um, Now, what does happen is, of course, the older you are starting that, the closer you are to your life expectancy. And so the premium's much higher for somebody in their 60s than it is for somebody in their 40s than it is for somebody in their 20s. So the earlier you can get started, the younger you can get started, you're going to gain the benefit of the mortality rate that says that as we age, the likelihood of dying, the likelihood that the insurance company is going to pay out a tax-free benefit starts to climb exponentially. And so ideally, you would start a charitable giving contract like that before it starts to exponentially grow in cost. So that's a long answer. The shorter answer would be as soon the earlier you can start, the less expensive it's going to be, the less you'll have to put in for compared to the value it's going to produce for the charity.
And this question, again, it's about charitable giving through life insurance. And I don't know if you can answer it, but there are specific types of insurance that are promoted directly for charitable giving.
Yeah.
Are they different than other insurance products, or are they the same?
So companies will brand them differently. The only thing that comes to mind that it is a different one that stands unique to any other type of insurance that you would apply for is what different companies call different things, but it's where you can give a one-time gift and have that one-time gift converted into an insurance contract. So, let's say it's $50,000. Well, that $50,000 would buy an insurance policy for you that might be worth $250,000. And they used to be able to do that way, way back. Even I don't even know if I could do it in my time, 40 years. But the Revenue Canada looked really, really dimly on that, but they've recently allowed it in the event of charitable giving, where you can give a one-time gift, have it leveraged up as an insurance contract, um, specifically for charitable use.
We only have a few more minutes, so I'm going to stop the questions there. But I want to thank you, Rick, for taking the time to join us today and providing our guests with valuable information on including life insurance in their financial framework. All webinars in our Legacy and Estate Planning series are available on UHKF's YouTube site, and an email with a link of today's video and a short survey will be sent to all attendees soon. I encourage you to fill out the survey included in the email, as it will help us plan future webinars and events. If you are interested in learning more about ways you can support healthcare, please contact UHKF office and we'd be happy to speak with you. And I want to thank everybody for joining us today, and have a great day and happy Easter.